All right, good evening, guys. Kenneth Tortoise Capital. This is the small group check-in for January 15th, 2024. Let's do our check-in as we go around the horn and we start covering our materials. I got Juan Carlos, I have you up first on the big screen here. Um, are you ready to kind of talk us through what you've got this week? And I have your notes on the screen.
Okay, cool. So yeah, I'm currently developing the master plan for the for a swing trading system. I started with objectives and what to do, what I need to do. The current task that I'm focusing in while working on the master project plan, I'm starting to the discovery phase for some method for market measurement. To identify market types and volatility. I intend to create some sort of component that will measure this for indexes and for individual trading symbols. And this is the first time that I'm actually doing this in a professional manner. I've been developing trading systems and stuff for a while, but I've never taken the chance to, to sit down, do the design, go through all the phases that I'm going to be working on before going start coding and developing entries and exits and that kind of situation.
Oh.
So yeah, I intend to continue on the discovery phase for measuring market type and volatility, and we'll focus on finishing my project plan, and that's what I have. I need to further more, try to find some statistical models to start working on this, and I was hoping to get some feedback on that, or where to start or what to look at. And yeah, that's where I'm at.
Yeah, so on market classification, these are the things that I think we have that are going to be useful to you. One is, first of all, just the straight up market class, which you see on the daily, which has let's see, no, this is, yeah, bull, quiet, bear, and then volatile, normal, and quiet. For swing trading, that one is pretty straightforward. That there is a favorable, we know from our research that those four quadrants are favorable for the next day, for like day +1. So what that thing does is divides the last 20 years into 9 different states, like bull, volatile, bull normal, bull quiet, sideways, volatile, normal, quiet, and then all the bears. So it classifies each day of the last 20 years as one of those 9 categories. And then for each one of those 9 categories, 8, 9, it then says what on average was tomorrow's price action. So if you bought today's close, what was tomorrow's close? So it's the close to close 1 day price action. And so when you do that, on average, those 4 categories are positive for the next day. These two, the sideways, I'm sorry, that should be bull, sideways, and bear. These two states on average are flat, so there's no advantage of holding it overnight on average. And then all of the bears on average tomorrow are down. So there's a negative contribution just on the basis of SPY. Okay. If you have the TC 2000 bundle or the I think they have it in the Thinkorswim, you can get that same analysis on individual stocks as well. So market classification is one of the things that you could use. The second one is the risk Z.
Okay.
Just trying to remember the name of it there. Yeah. So what the risk Z does is it compares the 30-day simple moving average of VXX, the index, versus the 10-day simple moving average of VXX. And under normal conditions, volatility looks like this. It'll spike up and then has a long, steady decay. And during that long, steady decay, this is good for the long side. That declining volatility is favorable. So under normal conditions, during this long stretch, the 10 period moving average is looking at the 10-day look back, and then the 30-day moving average is looking at that much. So the average of the 30-day is always higher than the average of the 10-day. So when you divide the 10 by the 30, if that's greater than, let's see, did I do that right? No, 30 divided by 10. If it's greater than 1, that's good, we said, and that means, yeah, I'm sorry, we divide the 30 by the 10. That's what it should be. So when it's declining, that means the 10 is lower than the 30, and that ratio be greater than 1. So that's good. Check.
Yes.
And then if it's less than 1, it's bad, because then you're on this side of the curve when volatility is increasing. So what we did was we went back 20 years and we computed what tomorrow's return was on the basis of this ratio. And that's where on the daily report you essentially get, if the Z score is greater than 0, it's above average, and then that was good. And if the Z score was less than 0, that was bad. So this gives you something like a swing trade market classification based just on volatility. So those two together are pretty good for describing if you got what kind of market classification you have for the swing trade. Another really good one is the MACD 4 seasons.
Yeah.
With on day trades, or a daily candle, also on the 3-day, by the way. So if you just take a look at the MACD 4 seasons and you look at the 0 line, you want to be swing trading when the market has turned into make that orange. It should be yellow, but it doesn't show up well. When it's in the spring and the summer, for sure, those are good for swing trading on the long side. Now the fall is not too bad, but you got to watch it, because if it dips into winter, then it's bad for swing trading. So about halfway up the stack in spring, all the way to halfway there, that's a really good seasonality for swing trading. Like you want to be initiating swing trades here, and holding it all the way through the peak until you give it 1 or 2 days in the fall. And then you just want to make sure that your stop is in place. So that's really good. There's a couple things that have come to my attention here lately, and I talked about it actually even this weekend. That is the slope of the RL30 and the slope of the Z-score of the RL90. This one is actually absolutely amazing. When the slope of the RL90 is positive or improving, I should say it that way, the slope of the Z-score, then that has been like a 60 to 90 days worth of really favorable market conditions for swing trading. And the slope of the RL30 is essentially just look at the RL30 on the chart, and it'll look like this. And anytime that it's past the 6 o'clock position and has started to improve, that's really good. And then what you do is you don't worry about the far side after it peaks, because what you have is any swing trade that you have has some kind of trailing stop, and the trailing stops function is to protect you against losses greater than 1R. So don't try to use the market classification as an exit strategy. Look at it as a time to answer the question, can I plant seeds right now? Can I take the risk? And then you have some kind of standard risk box based on the chart. And then then you can enter those trades anytime in that period, but you want to get it as soon into the spring as you can. And then just use the trailing stop as a way to protect you against losses, because individual symbols can stay positive when the market rolls over for a little bit while, because they're the leaders and people are going to be loyal to it as long as possible. So what I would say is those five things, we have a really strong basis of belief and evidence for them that they will help you with market classification as for swing trading. The thing on SQN for position sizing, I don't like that one. And the reason for that is because it's really vulnerable to short-term volatility. Can really, 1 or 2 days of adverse volatility makes the SQN go way small. But that's quite often a time when there was a sharp price sell-off and then it started to recover. And now you have a perfect swing trade entry.
Yes.
But because of the volatility event that washed people out, you end up having the smallest possible position size. Whereas what you want, I believe, is a standard risk of dollars per trade, and then use the risk box that's appropriate based on the chart, and then use that to compute the number of shares. Take a standard risk number, dollars per trade at risk, and then divide that by your risk box, and then use that for shares for position sizing. And I think you'll be better off doing that. Now, the other thing that I want to say is that concerning support and resistance from higher time frames that are more important, the best thing to do on that is you'll see that in the foundations course, is the multi-time frame, multi-lens analysis. And we use the 5 lenses, 3, 4, 5. And that's something like I don't remember all, and then monthly, weekly, daily, 2 hour, and 30 minute. And when you do that, you're looking at like this one's like the RLFF. This one is MACD, regression line crossover, tension stretch, and support and resistance. And when you start from monthly and go towards the 30 minute, look at the examples that I have in the foundations course. And what I do is I put that all on one chart. And so the monthly lines might look like that. And the support lines might look like that because you might have a price that's in here. And so when you do that on your chart, what you would say is that this thing is in this channel right now, but if it breaks through resistance, then that's an indication that it's going. And each time that it breaches one of those, that it has successfully gotten to the next target and beyond. But each one of those could also be where the resistance could hold. And now I'm going to be, as it approaches each one of those lines, I'm making sure that my stop is in place to preserve the move. And then by the same token, on the downside, every one of those moves is a place where it has held support before. And if it reverses, then that could become a good place for a swing entry to get long. Well, the ones that are especially important to me are those daily high and lows for support and resistance. The high and low, the day, and I would say the 10-day and the 30-day are really important for swing trading. I might go as far as the 150. And now what you're really looking at is the sniper trade location on 50, 30, and 10 days. Where is it in the look back period? You'll find that helpful. But certainly the high and the low of the day is really important. It's more important for day traders than it is for swing traders. But something like a 10-day high and a 30-day high and low is really important for swing trades. I think the 150 is more important for longer term positioning. When those hold, or those are violated, that usually is an indication that something in the trade has changed and that the underlying psychology has changed, that people were willing to let it go through support and resistance. Well, once you do that, like once a week, you could update that on a weekly basis for most of it, like the 10 and the 30. And once you have those marked up on your charts, those don't change because it's a long distance to that support and resistance. The daily bar for breakouts changes every day, of course, but for swing trading, I think once you do that multi-time frame, multi-lens analysis, you will get a price ladder of very important prices above and below. So if your price closed here, you get the high and low. Those are important. This might be the weekly and the 10-day and the 30-day highs and so on. So you end up getting that price ladder. And then this thing will trade through those support and resist. And every time it breaks through, that's actually a more favorable thing. It's going and going. And then each one of these price levels on the way up is like a test. It has to prove that the buyers who are just coming in, who haven't bought it yet, are willing to continue to buy it at the higher price levels and not be discouraged by the resistance. They're still willing to buy it. And the evidence of that is that it's breaking through these higher plateaus of price. And the same thing on the bottom is that whenever it reverses, you now have a belief that says, now I've got an even stronger reinforcement of that as a support level. And now maybe if all the other seasonal indicators are right, I end up having a risk box. And now this thing, I'm buying it on sale down here below something like a zero line. And so then you're getting the longer swing trade. So I think if you put all those things together, depending on what targets you're looking at and how often you want to take a look at your trades, and how many positions you want to hold. We can talk at a late, make a note to yourself later that you also want to take a look at portfolio composition and also signals.
Mhm.
Because you're going to have to make a decision. Do you want to trade patterns from the mechanical system, or do you want to trade particular conditions like the sniper, which is based on pure trade location? And my argument is that the 3-day, 9-day sniper is really advantageous because you're going to get location plus volatility, and it doesn't require some like curve fitted pattern. Like I think it's easy to track things by pattern, but to me, the sniper on the longer term uh, offers some really low risk entries for symbols. So I would start with market classification, but then I would also start considering, do you need do you want to look at patterns or conditions for your swing trades? And no matter what, a rules-based approach is going to allow you to quickly scan a large population of targets. So now you can start thinking about, do I want just ETFs? Do I want to be specializing in a smaller handful? The more it looks like, the more you look like a sniper, the more I think you could even choose from as many as 200 symbols, and then pick the sniper patterns that are of interest. So there's some additional work for you to do in that area, but I think this is there's a lot of meat on the bone for you to work on there,
Yes.
and that should give you some ideas to get you started with. Okay.
Very cool. Thank you.
All right. Let's see. Got all right. Let's go with George. All right. I think these were the latest notes that you sent me. How are you doing? And what give us your check-in for this week.
Yeah, so I reviewed the videos. I feel like I made a lot of progress, surprisingly, and not on trading, just on psychology. So that was really
Yeah.
exciting for me. And so where I'm at, to make it quick, where I'm at is I chose my goals, so-called projects, and my first project is to create rules for the 3 and 30-minute charts. But I kind of feel like I'm blocked because I'm not really sure how to come up with a good set of rules.
Yeah.
I could just use Griff's rules or arbitrarily, pick stuff that I've heard, but I feel like that's not really going to be very effective. That's about it.
Um, I think let's see. Let me take a quick look at these here. So my spider sense is that you are interested in doing like swing plus day is how
Yep.
I'm viewing this.
Yep.
Whereas Juan Carlos, I think, is looking more at more mostly swing, I think, and maybe longer term. And so the 3 and the 30 makes sense. the 30 existing targets for the initial, I would say the initial quarter is a good idea, because that's going to allow you to work on things like having a population to scan from, to pick a couple to concentrate on for intraday and some for the swing trades. Having 30 to choose from allows you to do that. Plus, you can start comparing that to the work that I'm doing in the nightly. So you're going to, your trading would be well aligned with that. So
Okay.
that's one set of rules that you could use as a source, right? So that fit you. So modeling the hybrid swing trading that I'm doing. A second source would be to be strict on Griff's Kata 2 challenge. I think you're in that course now, are you not?
Yes, I am.
Yeah. One of the things that I would recommend for you to consider is, I think there's a really strong argument for focusing strictly on EWZ, DIA, and maybe one Forex pair, like the Aussie US dollar pair, to give you three significant targets that have enough daily volatility that they can be traded every day. So you're not, it's not like you have three symbols, then you have to wait 10 days before any of them become tradable. They're actually all three tradable on 3-minute and 30-minute charts. And you can use the Kata 2 challenge rule set for it. And what I think, based on your set here, is that we want to reduce uncertainty and chaotic processes by starting with a really stable set of rules. And Griff's rule set for the Kata 2 challenge, with him as a coach on the rule set, is the best use of your time for the Kata 2 challenge, the course and his rule set. And since he's trading those, that gives you a very specific and concrete example to compare your trading with. Like, you can compare your trade exactly to his on the rule set, and then in direct coordination with him during that course, you would experience strict rules-based trading. And then what I would say, because I'm doing EWZ, and I'm not sure if I'm doing DIA. I'm at least doing EWZ every day on the 30-minute.
Yeah.
You could also compare how I'm trading EWZ. I will add DIA to my lineup because I trimmed a couple other symbols off of my list. I'm going to add DIA to my set. And then what you could see is, you could see how EWZ, DIA, and I'll see if I can add the Aussie US dollar. And then you could compare that to Griff's rule set, and then my rule set, which is less strict than Griff's. And you would get to see how that symbol trades on a strict rule set and on a more relaxed strategy. And I feel like a month to 2 months of study on that would help you address the specific weaknesses in here. About, it's not a weakness, but needing concrete examples. You could compare your trades to my trades and your trades to Griff's trades, and then not sure how to come up with the rule set. Start with Griff's rule set, and then you'll see specifically what needs to be in a rule set, And then by studying your performance on the strict histograms and those process management charts, you can then decide, hey, which of those rules needs to be adjusted for you and why? And then that will lead you to understand the connection between the data of your results and the changes that you make in rules. So I would say trading each day, posting the trades in Campfire on those three symbols would get you squared away. Now, the weekly process map, I sent you a link to a couple videos on the homepage on tortoisecapital.net.
I watched them.
Okay, so that's what I mean by a weekly process map. This gets you started, but the other one is actually more detailed about how I go through plan, prepare, execute, and assess, with specific step-by-step checks.
Yep.
If you're using his rule set, it's your process map won't be as detailed. There's not as many steps, but then the timeline for a standard day of how I break it up into 30-minute segments, I think I would use the 30-minute segment model that I showed on the second video, and then make some notes to yourself about what you're going to do in each of those 30-minute segments. Now, it's not every 30 minutes you're doing something. There might be some like, hey, in the opening 30 minutes, what am I doing? What am I doing at lunchtime? What am I doing in the last hour? And so as you start making I would start drafting some notes in there. And then when you get something that feels close, send it to me for review. And then, that way, if you do those things, we'll be getting after 1, 2, and 3, which is how to create rules, how to measure results from the histogram. And then we'll use the data from your trade log to show how to test rules and improve results. So I would restrict myself just to those three symbols. I would trade them intraday. By exception, I would hold them overnight if you had a successful trade with markets money. And that way you're getting each day is a specific case study with up to 3 trades. And then each one of them is giving you results. You're getting 3 results, one for each symbol, and then one for the whole day in aggregate. And then that will give us a database of results to work with. Does that make sense?
Yeah.
All right, I think that'll get you started.
Thank you.
Alrighty. Let's see. Let's see, Jonathan, you had some notes in here too. All right, why don't you give us a quick check-in?
Okay. Well, so I've had family in town this past week and this current week, so it's not my normal routine. I'm not really going to be doing any trading, but taking that as an opportunity to do some other things, including get out on paper some of the issues that I found vexing with my intraday trading that I've had difficulty with. So a few of the main things are the what to trade for the 3-minute time frame or a 1-minute time frame, and the relationship of what's happening on the higher time frames to what's happening on the 1 minute or the 3-minute, which is relatively speaking noise when you start getting up to the daily and higher. And also with time frames, In the past, I've really tried to overlap what's happening on multiple time frames, which just really complicates things. And just watching what Ken is doing and what Griff is doing, it looks like you're just focusing on the time frame that you're trading and really not looking at any other time frames when you're actively trading. So, I've had some difficulty trying to figure out how much of an influence, say if I'm on a 3-minute time frame, what's happening on a 30-minute or a daily time frame, really has to do with these shorter time frames and how much I need to take that into account. And then one of the other issues is one of my goals was for intraday trading to be able to sit down, look at my market analyzers, see what's moving, and trade those. And when things are really moving, if you're not looking at it at the moment that it goes, then you're watching something that's just kind of going away. And I'm generally pretty good about not taking something if I can't find a structure to get on, but I'd like to try and find ways to do better to get on moves like that.
Yeah. Here's some things that I would say. Let me talk about, let's see, a system that requires lining up 20 variables per chart across 3 or 4 time frames is not simple and elegant.
That is true.
It's hard to reconcile that.
Right.
Now,
I've got to abandon that.
Now, what it may be is that there may be a set of criteria that are appropriate to get a target. And that if you had something like 20 variables and some combination of those means that the thing is good enough to trade, it becomes qualified as a target and you put it on your target list. And then the trading dashboard is only what you need to manage price.
I mean, doing that makes it even too complicated to even get a good dashboard. I'm really
Well, my
abandoning
point
that because
was
it
like
just didn't
this.
work for me. Yeah.
Yeah, maybe it's got to be greater than its 200-day moving average, and the volatility's got to be within a certain band, and there has to be a certain number of shares so if it meets all of those criteria, it's a good target, and then it may or may not be tradable, or it's tradable, but then it may or may not give you a signal to actually trade. Like the multi-variables get you onto the list. Now, my own personal feeling on that is that I would rather have 2 or 3 indicators that tell me the thing is primarily ready to go and not 20 different fundamental variables. Just a personal belief. So if you take a look at the way we did the sniper, at its most primitive level, we're saying, look, what makes it primed and ready to move is location and volatility. And what we said was it had to be exceptional on each one of those, on both of those, right? So on location, what made it exceptional was that if you took a look back period, say 150 days, it has to be in the top 10% of the 150-day range and be strongly overbought, or in the bottom 10% and strongly oversold. Because our theory of location is that when it's in these 2 critical states based on location, a breakout from that is significant. And a failure to break out, suggests it's coming back to the norm. or back to the mean, which is the 50-yard line. And so a move from the overbought that gets rejected, that comes back to the midpoint, is a tradable move over a 150-day period. That could be a 20 or 30% move. By the same token, if it's extremely oversold on a 150-day trading range, then this could be one of those where it has hit the bottom and now is going to be reversing. Or whatever made it come down to the bottom of that 150-day low could still be true, and now the thing is collapsing. And now it's a runaway freight train to the downside. So all other things being equal, the simple fact that it is significantly overbought or oversold makes it abnormally primed for a larger than normal move in either direction. So all we're saying on that is that when that price is in that location, you are much more likely to get a big move in a short period of time compared to how it moves when things are just normal. And then what we do with the sniper is that we take the 150-day look back for a long-term buy and holders perspective. Are those guys getting nervous? That's what we're looking for. Is there a reason for the demographic of long-term buy and holders to be nervous about that symbol? So if it was near its 150-day high, theoretically, those guys are happy. Oh man, we got this thing and it is now pushing a 150-day high. That's as high as it's been all year, basically, for the last year. So they are really concerned about holding on to gains. And maybe they're thinking about adding to it if this thing can keep going. So they are more prone to add their money to the trade on either side of it. They're going to be more likely to pull their money out if it starts failing, or more likely to add more money in if it keeps going. And the same thing at the bottom of the stack. And then we use the 30-day look back to represent swing traders. So if I'm a swing trader and I saw this thing over the last 30 days had reached something like a low, 30-day low, and has now given me something like this price action where I have call it an SSC. It has crossed the dragon, and now the dragon is rolling up. And then I say, oh, the amount of range to the support level is that. And then I got 2 scoops of reward to the top of the 30-day range. Then just on that look back period, the last 30 days feels significant to a swing trader because he's holding things somewhere between 2 days and 10 days or 20 days. He's used to cycling that much. So where it's been in the last 30 days now is important. So as I look at this, you were asking about which dates are significant and whatnot. If you're looking at swing trading, I will tell you that the 10-day and the 30-day trading ranges are really the most important ones because those are keyed to the recent memory that matters to swing traders. If you're looking to hold position trades, like I want to hold it from 1 to 5 months, then I would be looking at the 30-day and 150-day look back, and I would consider that like long-term swing trading, or like I'm trying to adjust things once a week. If I'm looking at short-term swing trading, I'm probably using the 30-day and 10 days. So the common one between all of those is 30 days. The reason that's valuable is because if we're looking at daily charts, what it has done in those 30 days has produced the RL30. And the slope of the RL30 is actually a really important directional indicator about which way is the trend going. So if I looked at price that looked like this, and that's the RL30, and I can enter in the bottom third of the look back period, of the 30-day look back period, then I have reasons to believe that it can get to the top of that box without an extraordinary market event. Just the normal oscillation of price can get it there. And then when it gets to the 30-day, now I can say, is there going to be a test? And if there is, then if it breaks out of that, now I'm into the next leg up. And so now I think about, hey, the next 30 days could be another box to the upside, just like this was a box. So now I'm using something like price ranges and 30-day blocks of price moving. And then I can look back at further look back periods and say, where were the previous support and resistance levels that now are going to be the next place that this thing fails? Right. And you see me doing that all the time on the weekend report when I'm taking a look at the 3-day charts and the 9-day charts, and I'm looking at the 150-day look backs and where is the key support and resistance levels. The more that you look like a swing trader, the significant support and resistance can be marked off by like 10, 30, 150, and that's sufficient really, because you're getting the long-term swing trade with those two, short-term swing trade with those two. And then in terms of tactical entry, if I use those look back periods to establish the key support and resistance levels, I can then make decisions on when is it favorable to go to the long side or to the short side based on what is the market doing. Like right now is a tricky one because the market has just made an extraordinary 150-day move and an extraordinary 40-day move, and we're pushing very close to the all-time high. So the easy money on the upside is already made. How much more upside is there in the year 2024 when we're looking at a catastrophic presidential election with enormous policy consequences for the economy, depending on which one of those morons wins? I mean, good God almighty. Either one of those guys is a disaster for the United States. And if either one of them represents a disaster and we're already pushing all-time highs in the market, you got to say, and we've already printed $10 trillion, you say, what are the economic and political bullets that haven't been fired yet? What are going to be the sources of an additional push to the upside? Like 3 years ago, we lost 40% of the economy due to COVID. So it had come all the way down. It was a 40% sell-off, which creates a 40% cushion of recovery to the upside before it gets to be challenging. And they printed $10 trillion and gave it to banks and large caps. And those guys spent it like drunken sailors on the S&P 500. So for the last 3 years, the S&P 500 has kicked the shit out of every other index in the world, which is unusual behavior. And all the large caps have been amazing. And then the sacred 7 tech companies, Facebook, Google, Microsoft, Tesla, probably some other, I can't remember the other ones, Amazon, those guys made all the money that there was made in the last 3 years. Those 7 companies are responsible for about 90% of the gains that the S&P 500 made. The rest of the companies in the S&P 500 were marginal. Well, all 7 of those things have made so much money that it's hard to see where the next $10 trillion of investable cash is going to be to push them higher. So what I've just tried to do is make the case that 2 to 3 years ago, the 40% sell-off created oversold conditions and created room for a 40% gain to the upside. Well, we're there now. We're at the top of the stack, pushing all-time highs. And if Trump comes in and dramatically changes all the economic policies that the Democrats have in place, and if those guys win the House, and it's at a razor's edge right now, what does that do to the investing climate? But if Biden wins and he keeps or doesn't keep so all the variables for politics for the next 12 months, 11 months, is the maximum amount of uncertainty that you could have. Oh, and by the way, 3 different hotspots that could lead to World War III and nuclear weapons: Ukraine, Taiwan, and probably Poland, right? And just the wider NATO.
It's North Korea.
And well, yeah, North Korea, just because but he's not especially crazy right now. He's just normal crazy. But the other 3 are hotspots that are close to generating new shooting wars that involve nukes that we haven't filtered in before. And yeah, so anyway, the upside is really hard to see. It's easy to find reasons why we could experience a 20% loss in the next 11 months without even trying hard. At the same time, the Democrats would all be interested in printing more money so that the economy doesn't look like a disaster, so that there's less reasons to vote Trump in. Like if the economy and the stock market start collapsing, now all of a sudden people say, well, Trump was really good for the economy last time, so even though I hate his guts, at least he can fix the economic disaster. So for the next 11 months, every time there's going to be a significant sell-off, as people try to preserve pieces of that 40% gains, there, as soon as it falls 5 to 10%, there's going to be a trigger to start printing more money and more rate cuts from the Fed. The Fed has already told us that they're ready to start cutting rates again this year. So there's a lot of tactical policy choices that are coming in. And all of that is really good for swing trading and really problematic for long-term buy and hold. Because you say, where is the target for a long-term buy and hold that isn't already near the top of the stack? Am I going to bet on some, crypto? Are you nuts? So my point is that the swing trade should be very, very good in the year 2024 up into the election. And then from November till about February 2025 should be very good for taking new positions for the next set of winners that will benefit from whichever new administration comes in, and then depending on who gets the House and Senate. So all of that tension and chaos should be resolved by February next year or by January next year, unless the election gets contested. And then who knows, right? So my point would be, this is a really good time to be swing trading. And so, in my view, you got to decide if you want to concentrate on the longer term or the shorter term for swing trades. And either way you go, that little set of symbols right there is not bad for tradables on swing trades, but you might expand it all the way to the 30 symbols that I suggested.
Well, I'm really looking at trading intraday timeframes.
Okay. Well,
and you know, is a 10-day or 30-day look back for a trade that I may be in for a couple of hours. Is
Yeah.
that
That's
really
even better. That's
Well-
even better, by the way. In the scenario that I just painted,
Okay,
what I'm going to suggest to you is that if your primary focus is to smoke them while you got them, in other words, get it while the getting is good. The
Yeah.
intraday move is when it's good. So the 3-minute and 30-minute time frames are really good for capturing the daily move. Now, one of the things that will influence the daily move is where the daily move is compared to the 10-day move. So if that's the 10-day high and that's the 10-day low, now the same relationship that there was between the 150, the 30, and the 10 is now the same as the 30, the 10, the daily, and the 30-minute. It turns out that understanding where the daily, so if this was the 10-day range, and I'll try to build it out this way. If that's my overbought, and that's my oversold, and if yesterday's trade was right here in the middle of that 10-day range, then the significant, and if that's tomorrow, the significant price levels that first affect your intraday trade is, today's high and low, or the day that just closed. The high and low of yesterday really matters for today. And so you carry that forward like this. Now, if that thing opens up inside of yesterday's range, like it opens here near the low of yesterday, and then holds support at yesterday's low, like if that holds, then I have reason to believe that that we could see a range stat move, which could be that far, which could take us most of the way to the 10-day high. The 10-day high is going to be significant for everybody that is a swing trader, right? There's the fast swing traders and there's the slow swing traders. And the slow swing traders are looking at the 150 and the 30, and they might use a breakout from a 10-day high as their trigger to enter. Like, oh, the short tactical term broke out, and now I can get my long-term swing trade. And they're looking primarily at the 150 and the 30 to establish their boundaries. The fast swing trader is probably looking at the 30 and the 10, and then the daily breakout. Now, this is consistent with the triple screen time frame management that Alexander Elder talks about. He says there is a primary time, and then there's the next higher up, the long term, and then there's the tactical time where you drill down to get an improvement on price. So you want to get an improved entry based on tactical time. And this is your primary management time frame. And what you're looking for on the higher time frame is a strong trend that establishes a preferential direction. Like in my view, if we are above the 200-day moving average, and we're also oversold on the 150-day look back, that becomes a perfect time to hold support and then have an easy climb back to the top of the stack. Right? So the primary trend in this case would be the 150-day look back is, and the long-term price is above the 200-day moving average. That's good. What you're looking for is a pullback on your tactical time frame. And so that is, this pullback into oversold conditions is significant enough to get the guy's attention that he can buy on a dip And then when that holds, you get a breakout on the tactical time, then you have the beginning of evidence that this thing is getting long, and it might be doing that. The more it goes up, the more it should go up. And now you're going to get momentum and a reversion. The previously strong trend is going to be more important to help convince people to buy, as opposed to the negative Nancy's who look at the pullback. The fact that it held support creates the buying quality on sale. Hey, I can buy a Rolls Royce at 10% discount. Great. That's the best. That's what I want. So if you're looking primarily to be an intraday trader, you care about the 10-day and the 1-day look back, because the 10-day is going to give you a reasonable price target for the fast swing traders. You see me do that every day with the auto framer. I compute the reward to risk ratio of the auto framer by taking a look at today's range and calling that 1 unit of risk. That's my risk box. And I count how many of those risk boxes there are. If it just goes back up and retests the 10-day high. So that's a case where there's a 4-to-1 reward to risk ratio, and it could take 2 to 10 days for it to climb back up to the 10-day high. So as long as it has fallen, the farther it has fallen from the 10-day high, the more room to recover there is, as long as the 10-day low does not get violated. Check or hold?
I think I follow that. I'll process that. The 3 time frames that you just, I mean, that's what I was doing, is I'd have a primary time frame, there's a time frame above and a time frame below. And so I could squeeze in
So
an
if
entry.
so what I'd be looking at is on my chart, if I look at a 10-day look back as my primary, I can use 30-minute charts on a 10-day window, and I have about 130 bars of data, which is enough to let me see a couple interesting moves of the dragon and the RL10, and then those give me intermediate levels of support and resistance. Like if this has just started to reverse here, I can now look at this and say, oh, perfect. This support level and that support level held twice in the last 10 days. And I could buy if this was yesterday's range, I could buy 5 cents above yesterday's high. And now my risk box would be this. And then I can just quickly compute and say, yeah, to the 10-day high, as long as I got 2 boxes, I'm good. But that's 6-to-1 right there. Perfect. That's as complicated as I need to. I don't have to have 20 different variables. What I'm really using is location and volatility. So the smaller this price was yesterday, then the smaller my risk box is, and the better my reward to risk is going to be. And the less I have to, and the closer it is to the 10-day low, the less I have to lose in order to get into the failure trade, which is a collapsing dragon. And now I'm ready to go that way, because whatever caused it to fall from the 10-day high to the 10-day low must be true. I can just infer that that's true without knowing specific reasons. And now I'm good to go. So I can now use the 30-minute chart for my tactical trading, because now each day I've got 13 bars of 30-minute charts, of 30-minute bars, to form my daily trade. I can actually use the last 2 to 3 days as my tactical move, and I can use the 10-day high and low as ultimate targets. And you see that on the nightly podcast that I'm doing, where I'm looking at updating the the hybrid swing portfolio. I only show about maybe 3 to 4 days of look back. But you can normally see the 10-day high or the 10-day low. One of those two is more important than the other. We're either getting close to one or whichever one we're closer to. I try to put that in there as a reference. So what that will do is give you a reasonable, simplified and elegant, almost a hydraulic view of the flow of price action. And then the description of the flow, the visualization of the flow is really the dragon and his turning points. Those are statistically significant turning points that give you reasonable places to put support and resistance over the last 10 days. So I always know where those are. And then for further refinement, I can use the turning point of the RL10 is always a very precise point. And it always is it's higher than the turning point of the dragon on the upside and lower than the turning point of the dragon on the downside. Right? So you have a channel that is formed like this with very precise points for the endpoints of the RL10. And then the dragon trades inside that about 80% of there's always that little bit of gap between the peak of the RL10 and the peak of the dragon. And the dragon is always smoother than that. So you actually have a couple turning points that you can, and you'll see the RL10 turns first. And then maybe when the dragon turns, you use that for confirmation. And then when the RL10 crosses the dragon, that's what I use as my indication for entry. So that is a very simplified set of behavioral characteristics on the indicators that I can use to refine my entry and exit techniques. And then a subset, I'm using the 30 symbols. That looks like a pretty good reduced set. Like if you wanted to concentrate on 6 or 7, that's a pretty good set right there. I might add a 4x pair in there just so that you get a feel for trading the Forex. Like I might add USO for oil, and I might add the Aussie dollar US dollar pair. And then the USO would give you insights into how Devon Energy moves. So you could see the commodity versus a company in the energy sector. And then I might put the Aussie dollar, US dollar, just to see how Forex pairs trade quite differently from equities. And then that'll give you, with just 2 additional symbols, a wide open view of the world of commodities and Forex with these standard techniques. And then you have a couple metals, Alcoa and Cliff. You have a couple broad international indexes, Mexico, Brazil. You have a big fat conservative US index that looks like the S&P but slower. And then you have IP as a mainstream fat industrial mature company that happens to trade like a maniac. So that's a really good subset to give you working knowledge on where these things are. So where you want to be on those is I would start off with where are those things in the 10-day look back? And when they get near overbought and oversold on 10 days, they're coming into prime time setup area. And then they should move to the top of your list because they're more prone to make swing trade breakouts And then if they make a swing trade, if they may start with a daily breakout and trigger a swing trade breakout, so you get a double large move on one day, and that's the day that they become amazing.
So that translates down to a 3-minute time frame. If you're, it's
Right.
really because
Exactly.
the daily move is, and the daily range is it sounds like the most important thing for a 3-minute time frame.
I think so. I would always
Okay.
include the 10-day.
Okay.
I would include the 10-day look back, just so that you knew if there was a catastrophic move getting ready to happen. Like
Okay.
a 10-day a breakout from a 10-day high or low could be
Okay.
double catastrophic. And then the 1-day, whatever the 1-day high and low was, I'd be looking at that as a really strict boundary as well. So I would know the 1-day high and low, the 10-day high and low, and then I could use 30 minutes to find the turning points, and then 3 minutes for the tactical breakout of like an SSC. And then I would use that combination of SSC, collapsing dragon, and Kata 2, because at every key turning point where the RL30 reverses, if that thing works, you're going to have an SSC that works. And if that works, you're going to get a bunch of Kata 2s all the way up. But if that fails, you're going to get a collapsing dragon down. So out of that critical state, all of your tactical trading develops, and you have rules on how to go this way and rules on how to go that way. Simple.
So if you're on a 3-minute time frame and you're trading it, are you also looking at a 30-minute time frame and looking at a turning point there, or you've looked ahead, you've kind of seen what the range is for the daily and maybe where the 30 is, but you're just looking.
What I will do is what I do with the nightly, before the market opens, is I'm taking a look at the 30-minute charts for the last 10 days, and I'm plotting all of those resistance levels, which, if they break, are going to lead to collapsing dragons on the 30-minute bars. And then on the upside, every one of those that looks like it successfully created an emerging dragon, I know where all those price levels are. So you draw them on the 30-minute chart. And then when you go to the 3-minute bars, those lines will be there, but it will look like there's wide ranges in between them.
Okay, so and so you've got that on your chart, but you're not looking at what's happening on the price action.
No, I'm looking, if I'm
You're just
managing
looking
the
at the
3-minute, I'm
30-minute
looking at the
and where those
3-minute,
levels are.
and I look
Okay.
at that. So now the RL10, let's say the RL10 looked like this on a 3-minute chart, and it starts to reverse, and then it crosses the dragon on the 3-minute bar, and the first and the PSAR's coming down, and this was the first peak of the RL10, which now if this thing gets through there and it gets through, I'm saying check. I'm not going to lose money. Now, what's the next target where it's going to test? Oh, there it is. And if it gets through there, it's going to go to here. And if it gets through there, it's going to go to there. So now I have like 3 regions of upside potential. And then all I'm doing is, as this thing climbs up the stack, it climbs the wall of worry, it's going to get up here. And then I'm saying, critical state, is it going to fail? Okay, I better exit. Oh, it made it through. Am I better than 2R? I can add a second scoop. And then it should go fast up to here. And then it's going to test. And then it's going to test. So these are all standard. What does it do when it gets near resistance? It's either going to fail, stumble around, or just blast through. Every time, every single time. So I can plot those out the day before by looking at the 30-minute chart. And I can put all of those collapsing dragon and emerging dragon prices in. And the good news is that if you're looking back, 5 or 10 days, a lot of those don't change until you get there. right? Like it may take 5 days before it ever gets up to this one, but once you put that on the chart, it's always there. So it's not as painful as it sounds.
Okay, okay, that's good. I appreciate it. This is one of the
Yeah.
things that generated a lot of indecision is I could be on, for example, 3-minute time frame, and I'm looking at the
Oh, no.
trying to get those to
Yeah.
the-
Yeah,
the
so
30
watch this. So watch this. So if you're on the 3-minute bar and you're looking at the RL10, if I multiplied that by 10 and I looked up at the 30-minute, if I looked up at the RL90 on the 3-minute bar, that's what the RL10 on the 30-minute bar looks like. So if you plot the RL90 and you see that thing reverse, you know that if you went and looked at the 30-minute bar, it would have reversed. The RL10 will have reversed up there. So you don't have to switch back and forth between time frames. So when you use the combination of the 10, the 30, the 90, and the 270, those are fractal. So the 10 and 30 on the 3-minute, if I go up to the 10-minute, it would look like the 30 and 90. The 30 and 90 on the 3-minute bar looks like the 10 and the 30-minute on the 10-minute bar. So by having those on there, I don't have to switch time frames, or I don't have to split my screen between, hey, here's a 30-minute chart and here's a 3-minute bar chart, and then try to interpolate. Now you can try that. If you look at the TC 2000 bundle, we have some setups where we are looking at multiple time frames on those. But what I have found is it's better just to trade on the time frame you're on and know where those larger levels of support and resistance are, which are signals that the next higher time frame traders are going to activate. That's what I would say on that.
Right. Thank you.
Yeah, let me clear that real quick and let me security lock the meeting, keep the rabble out. Market was closed today, so there's no reports. All right. Jeff, sorry to keep you waiting.
No
I
problem
can't-
at all.
I don't remember if you had sent me an email.
I did not, but I will start doing that.
Good, then I didn't miss something. I mean, I
Yeah.
knew that.
I
mean, I knew
didn't
that.
know, I didn't know it was much of a thing as it is, so now I know.
Well, I mean, it's really just that was just these guys being nervous in the service and wanting to get it on paper earlier. And
Well,
probably a lot of the things I covered here will give you things to think about.
sure,
So,
sure.
why don't you give me your quick check-in? Let's see what we got.
Sure, I kind of used your template. My project sentence is to create a system of systems that includes 3 fully automated bot traded systems that are trading live, at least at some level of scale, by November 1st of 2024.
Okay.
Some add-on thoughts to that. I'm assuming.
Was that an intraday were you talking about?
Yes, sir.
Okay.
I'm not opposed to a swing flavor if that's really, I'm not opposed to that, but just trying to focus on more intraday at this point.
Okay.
Some
Yeah, I mean, the question was really, is it going to take a entry signal from a live price feed when a certain price is hit at that moment, it triggers an entry, or is it sort of a semi automated where it will recommend a trade that a rule was hit and then you trigger that, yes, I want it to fall, or whether you're waiting for end of day data to confirm a move and then place a trade for the following day. That's really the issue in there is going to be whether or not live price action triggers a live order entry, and then whether or not that's fully automated or partially automated, human in the loop or not.
Right. And, I know that a systems-based discretionary is supposed to be the most profitable, et cetera, but I would prefer it to be fully automated. But again, we'll see where the systems take us and the results and things
Yep.
like that. But my thought is fully automated, 3-minute, 5-minute, 15-minute time frame, something like that. And some add-on thoughts to that. I'm assuming the best, maybe only way to accomplish this in that time frame for me is to leverage some community member systems like the PRX crypto system. You
Yeah.
mentioned, I liked some of those videos. They were great. The $1 million ideas. There's a couple of those hanging out there, and just a matter of whether those guys are willing to share, the details.
Oh, they will.
I noticed a couple of them you were talking about making them classes or something, so I thought that'd be, a great way for me to maybe vet some stuff early if they have it.
Yeah, I mean, I like to have a prototype student who's working on it, who wants to use it, and that usually is a good way to
Sure.
incorporate an end user in the development of a system and then of a class to get
Yeah,
the
you
rules
bet.
really clarified.
Love to get feedback and all that. I liked your good enough concept that you spoke about with Luke, instead of, again, the thought there, I don't necessarily have to take a system and then reinvent everything from scratch. Like, well,
Yeah.
let's try to speed things up. And
Yeah,
then,
just for guys that may not have seen that one. So Luke had something where he just takes a daily price action, and that may trigger 5 or 10 trades during the day, and he just takes that as an aggregate daily trade and rolls that up into a net, like a net trade, and that gives him one number from today. Today was a 2-hour day or a -1 hour day. And then what he gets is he gets good enough individual trades, not optimized, but good enough and multiples of them. And when the individual rule sets are good enough and you take a bunch of them, you end up getting an even more satisfying net trade. And then the daily net produces a really good weekly return. And so this is something where he had the individual trades had like a 54% win rate that I want to say paid 2-to-1, but you get 10 to 15 of them a day, and it translates into 80% of your days are winning days net, and 80% of the weekly trades are winning weeks, something like that. So you're getting the that's like trading like the house, in Las Vegas. Yeah. So in the automated portion of that, and that's where I would even suggest, working with Luke would be is certainly within the range, because he's done some work on automating those particular, and he's been automating the DAX as well as Forex trading. But Jeff
Right.
Bocasio's an trade automator, has some skill in that area too.
yeah, you bet. And, but you also talking about good enough. I like you said, people are always coming up and asking him or you or somebody else, hey, have you tried this?
Yeah.
It's like, why?
There's
would you-
there's a certain ironic humor
Yeah.
on all of that.
Yeah. His
It
daily
says,
estimate is
It
high
says, hey, we've been
fours or
studying
five.
this for 5 years. We've been studying this thing for 5 years that gives you 20 trades a day that has a better than 50% win rate and easily pays 2-to-1. And then rather than trading that, they just say, well, have you thought about, yeah, we thought about it. Or maybe we didn't. But I also like hearing have what they think, what they're thinking about, have we tested, just in case I haven't thought about it. But at the same time, it's also one of those things like, well, here's a free sandwich every day for you. Well, have you thought about okay. The first thing people want to do is change the rules.
Well, necessity for me, where again, I may be losing my job at the end of the year, is I think I'll just take the free sandwich and thank you for it instead of trying to, make another one better.
Yeah, I would take a look at, and all of you guys too, the modified BMR rule set that Bill Scheit is working on. He's working on a course or class on that. That's like a long only, for him, a long only weekly swing system that shares a lot of the principles of the PRX cryptos, PSAR flip, and some of those rule sets. So it takes the BMR portfolio of big fat ETFs and tries to own strong relative strength, but incorporates some of the technical goodness of the PRX crypto system. So I think it's like swing trading the BMR. So the BMR is a monthly rebalancing based on a calendar rebalancing. The modified BMR is really taking a look at conditional trading. Like if this price action happens, then you trigger a trade in a BMR candidate. Like you're not waiting to make decisions at the end of the month only. Like if the condition happens during the, and the thing that I think is great on that, I don't know if he's incorporating it yet, is what my brother's doing with the 3-day and the 9-day sniper is really a very relaxed swing trade that we're using a 3-day bar. And what we're looking for are conditions where it was harsh winter reverses on a 3-day, the R10 reverses, crosses the dragon on the 3-day, and then we get some initial positions. That should be green, sorry. We get some initial positions here with a tight risk box. And then and that's like 1/3 of the position that we end up wanting to build. And then if that thing just keeps going up, and remember, it's got a wider stop because the PSAR flip is based on a 3-day bar and not a 1-day bar. So that's actually wider than a normal daily PSAR flip. If that thing just keeps going up, eventually on the 9-day, you end up getting the same pattern where the 9-day has reversed and crossed its own dragon. And then you get the remainder of the position when the 9-day gives you an SSC. And then now you merge those two and up it goes. Like that would, after the catastrophic sell-off of the COVID, that 3-day, 9-day reversal would have gotten you back in within about 2 weeks on the 3-day and about 4 weeks on the 9-day, and you would have enjoyed a 75% gain and gotten back in early. What we found was the hardest thing in the world was to take the exit when this thing started selling off, but then it avoided all of that sell-off of the COVID. That was the second hardest thing that there was to do, was to take that exit and stand aside. And then it turned out to be easy because, oh yeah, the market collapsed. But what was harder than taking this exit was taking this entry. Because for a long while, we were just enjoying the fact that we were not losing money and everybody else was losing money. So our performance was relatively good and we felt calm and relaxed. But then when that market reversed and starts climbing the wall of worry and you get a lot of volatility in that turning point, now all of a sudden you're just like everybody else. Am I getting in too soon? I don't want to wait too long to get in, so I don't want to miss the move. So this idea of the 3-day and the 9-day turning points, using the sniper psychology and all that, turns out to be a really good way to benefit from catastrophic sell-offs. Abnormal sell-offs are always interesting. Now, for you guys that are swing trading, it may be that the mechanical patterns, now all the way up there are times and places on that move up where mechanical patterns will hit. But the longer I do this as a swing trader, the more I am persuaded that simple is better, and that simple trade location plus volatility, this gives you the setups and very clear, precise prices. This one tells you the psychology when the psychology is abnormal and then reverses, you're onto something in the tactical time. There's something really powerful about that. So I would strongly encourage all of you to become very familiar with the principles of the sniper. I'm going to find the write-up that I did on that. I did a shorter version of it for the book that has a very clear articulation of what the edges are. And I really think the sniper is a core, robust advantage, and that other things like SSC and Kata 2 and Collapsing Dragon and mechanical swings and 3-day, 9-day, all of those are like implementations of some of the really important psychological and tactical beliefs of the sniper. The mentality of the sniper is that you find targets that are in a compound critical state for whatever reason on any time frame, whether you're looking at monthly charts or minute charts. A compound critical state is a bundle of reasons, and more is better, about why this thing could explode, because multiple people are going to have emotional reactions when it finally reacts. The abnormal volatility on that looks like this. It's either already on fire and moving, like it had an extraordinary 5-day range. It's already in play. It's going. Or yesterday was a huge day up after 10 days down. So you see the volatility already unfolding, and the fact that it's moving now, like there's a great big bar and it's going. You don't have to wait to wonder, is it going to start? It's going. Now, you missed the first bar, but that first big bar suggests that the next 2 or 3 bars could also be large in that same direction or revert, but it's going to be large. So abnormal large volatility it's dramatically in play already. You see it exploding. My favorite is at the other end, abnormally quiet. And it's like every cowboy movie, it's abnormally quiet, where the guy says, hey, it's quiet. Yeah, too quiet. It's 3 o'clock in the morning when the French and Indians attack. And that's characterized. What you love to see is a big, strong move that then diminishes into the tiniest little doji that there was. So you have a combination of a large directional move and then the tiniest little doji that range is compressed. And then you have the smallest breakout box ever. And then once it breaks out from there, momentum may cause people to keep piling on, and what was a small breakout becomes a large breakout in either direction. So it's like day 0, just before somebody steps on a landmine. I think of it as sitting around a pond late at night, absolutely quiet and no waves. You could hear a pin drop. Absolute stillness in the pond. And somebody throws a stone in the middle, and now you get an abnormally large splash. It sounds like a big splash, but only because there was no other noise. Whereas if this had been just a pond during the day, a stone of that size might have just made a splash that just felt like normal. It was the absence of all the other sound that made this exaggeratedly large, which triggers a surprise reaction. Think about the the herd of cows that are all bedded down for the night and it's absolutely quiet. And somebody yells, "Wee!" And now suddenly they're all startled out of their sleep and they bolt and they run. Well, during the day, when this herd is already moving, the cowboys are yelling and hooting and hollering, and they're just moving along because it's a normal sound. It's the context, the absence of volatility creates the abnormal quietude, which then triggers those extraordinary moves. So the trade location I talked about before, the 10-day, 30-day, 100, I call it really 10 bar, 30 bar, 150 bar. Now you're thinking fractally. But for swing trading, it's reasonable to say 10-day, 30-day, 150-day, and use 30-minute, for the tactical moves of the 3-minute. But it's the absence of volatility which creates the abnormal quietude, the abnormal volatility. And then you combine location and that's like some guys are sitting on the end of a cliff. They bedded them down for the night and they're right on the edge of the cliff and they don't know it. And now somebody spooks the herd and they go through the bushes and then they immediately fall down because they didn't know the cliff. They didn't know they were on the edge of a cliff because they didn't look around enough. It was the context, the quietude and the location. The volatility and location is the essence of this sniper. And then all we're going to use is a couple standard patterns. The SSC, the Kata 2, collapsing dragon. Those three taken together on every time frame are really all you need when it's moving. When it's not moving, you need some for the abnormal quietude. This is what you use when it's already moving. The harsh winter told you that the SSC is coming. So it had to move already. It's in play. When it's very, very quiet, you need the Z3 pinch or the super pinch to tell you that we have abnormal quietude and all the price action has come together like a little acorn or a jack in the box ready to explode. Hasn't exploded yet, and the breakout is going to catch them all by surprise. And then that triggers all of the subsequent momentum trading that's going to lead to a series of Kata 2s forever and ever until it goes and hits the 10-day high, the 30-day high, the 150-day high, whatever previous resistance level caused it to fail last time. Hey, Ken, what happens if it's already at an all-time high? Then you have the problem that I have, what to do when there's no upper bound. That's a really good problem to have. And all you're going to do is a trailing stop and just let it run. Let the big horse run. So
Was
that's what I
Bill,
wanted to say about that. Go ahead.
great. That's good. Was Bill Scheidt's system you just talked about, was that one of the three that he presented in the video?
He talked briefly about it. He's
Okay.
actually building a course on it.
Okay.
Tell him you talked to me and that you want to be on the team that develops that.
Okay, that'd be
to
great.
be a like a prototype end
Prototype
user.
tester. Okay.
Yeah, just to be someone
And what's it called?
Plus, it's called the modified BMR,
Okay.
and it basically combines some of the elements of PRX, the technical rules, but using BMR rule sets to find candidates, and then it refines the entry using like PRX rules. It's
Okay.
if you use PRX rules, but on the BMR portfolio, what would that look like? So he's done some things over the last 10 or 15 years with his retirement account, with his kids' college fund that have been very, very risk managed. If Juan Carlos, if you're interested in that too, then both of you talk to him on that, and then we'll set something up because he's going to end up building a course on that for me, for us.
Okay.
And so it's always helpful to have an end user in there to ask the good questions that we want asked.
Sure.
Okay.
What
What else you got, Jeff?
Just real quick, the other three things that I was just for candidates for systems.
Yeah.
To start looking at, Jim Carroll's long short volatility. We
Yeah.
talked about that. That's a PRX variant.
Yeah, that's it. Yeah, that's already connected to the PRX rule set.
The Williams percent R breakout by
Mhm.
Jeff, and then the Crawford's DAX breakout. I thought they're all some of those are a little bit different.
Yeah, the Jeff's NDX breakout looks very much like an improved entry like for an SSC or something. You can get some fine tuning on that, and it's well suited to making it robotically traded. So I think that's
is the NDX the same as the Williams percent R?
yeah, that's my name. That's my name for it.
Okay.
My version of the Williams percent R is an improvement of percent
okay.
R.
That's right. He used that and then went with his extra indicator. Okay.
Yeah, because the problem with the Williams percent R was that it uses the live bar to calculate the 0 to minus 100. So if you had 9 bars in a tight compression, and then the live bar started dropping like a rock and it's down here, it would read minus 100. And you would have no idea that this thing just had a catastrophic sell-off that left the previous look-back period behind. So I improve that by saying, look, we're gonna cut it off at bar -1 and go back to bar -10. And then we're going to set this equal to 100 and this equal to 0. And then when if this bar breaks down, this can actually go below 0. So if this was a -100, what that would tell you is that the amount of breakdown below the previous low was equal to the size of the 10-day look back. From high to low, that's 100 units. So if this thing is at -100, it fell as far in this bar as the last 10 days from the high to the low. So this one number gives you a sense of the magnitude of breakouts. So under normal conditions, if yesterday's move was, the -1 to the -10 looks like 100 to 0. And if today's bar is right here and it closes right here, and that'll give you a reading of 50 because you're like at the 50-yard line. That tells me that today was right inside the last look back period's normal. So there's some black box of rules down here that are driving price to do whatever it's going to do. And it's at the 50-yard line today. I can infer that nothing changed, nothing unusual to see. But if I'm looking at the 10-day look back, and this thing is in the top 10% or the bottom 10%, and then today closed inside there, I now have a number that tells me I'm right at the boundary of a catastrophic breakout or a reversion back to the mean. So that is now a critical state for overbought. And the same thing down here for oversold. Now, if that happens today, when this closes here, I now have a compound critical state. And now tomorrow, and this is for Jonathan, that's a really good indication that tomorrow is an exceptionally good day to trade that one intraday because it's poised on the edge of a cliff. So if it opens inside the normal range, it's easy. if it's at the extreme of the look back period in the top or bottom 10%, I have a normal reason to be excited. But if today broke out of that range altogether and it closed at plus 200, I now know that today was a great big breakout day that left the last 10 days behind, and this thing is a raging breakout. Or if it went down below zero to minus 100, I know it was a raging breakout to the bottom side. So in one single number, the NDX, I get the trade location compared to the previous 10 bars, but I also find out where the breakouts are, because those are the abnormal price moves, and it tells me which ones broke out and what the magnitude of the breakout was. So if I am sorting by the 10-day NDX and I see some things that were like at 100 and 105 and 107 and 350, I know that there were a couple things that had small breakouts. I know there was something that was right at the boundary, and I know there's one thing that just absolutely blew up. That one gets my attention every single time. And now if I'm looking at 500 symbols and I sort it by the NDX 10, I can find the big breakouts, the overboughts, the normals, the breakdown or the oversolds, and then the big breakdown. So I look at it in terms of that kind of a sorting mechanism. You don't get that from a percent R because percent R includes today's price bar into the calculation. The worst thing that could happen to you on a percent R is today it had a big breakdown and then it closed back up in the middle up in here, and you see a reading of minus 50 and you think it's business as normal, and you are completely invisible to the fact that that thing had a horrible breakdown. Now, if you use the NDX on live price data intraday, it's even better because it will alert you to new breakouts. But I use yesterday's high and low of the day as the 100 and the 0. Now I find out, did it break out above yesterday's high? I'm automatically interested because it's in the green zone. Did it break down below 0, below yesterday's low? I'm interested because it's in the red zone. But if it's inside yesterday's range, it's in the yellow zone. That's a primitive, simple, but elegant way to organize price location when you're looking at multiple symbols.
So it's not using a 10 bar, it's just literally yesterday's high and low.
Yes, just put
Okay,
an
makes
index.
sense.
Just
Yeah.
put an index on yesterday's bar and set that equal to 0 to 100 like a thermometer. And now you get alerted to the exceptions. Beauty.
It's great.
That's the way to do that.
Last thing for me is resources I still need. I wasn't able to find Ken Hum's or Jeff Southern's videos.
Okay,
on
if yeah, I'm going to put it in the small group on Rizuku, on the OWL group. It should be, I know, I'm 99% sure that I put Jeff's in there. And it was Ken
Go for
Hum's.
it.
Yeah, I
Oh,
100%.
no, I didn't see Jeff's. I'm sorry. I thought you meant Boccaccio.
You saw Ken Hum, but not
No,
Jeff
no.
Southern?
No, I didn't see either. I thought you meant Jeff Boccaccio. Sorry.
No, oh, no, I meant, well, actually, I thought that Boccaccio's in there too. I will go double check and get those loaded in there. Jeff Southern's is really good because that's going to give you some insight into what 4 or 6 months of persistent work on these projects ends up looking like.
Yeah.
You know, that's sort of his travel log of 6 months of work on the creativity course, which is kind of what you guys are doing, but a little more focused on trading. Not so much on creativity, more focused on advanced trading techniques. So I will go verify that before I before I go get more coffee, I'm gonna go and make sure that that those are loaded up. So if you look I think it was the last lesson in there, I had put a bunch of videos, and I'll make sure that those two are there. So
Yeah, that's-
Bocasio and Ken Hum,
No, Southern and Ken
Southern.
Hum.
Okay,
Yeah.
Jeff Southern and Ken Hum.
Bocasio was in there.
Okay, yeah, I for sure remember putting this in. Okay, Satya, what you got?
Sorry, I didn't send you any email. I just wrote down a couple of points, but in today's lecture, some of my points is already explained. So I had only this question, NDX, like how we can use it for the breakouts, like which number you have to look into this, like above 100, or you were saying if it is like 350 or above 250.
Yeah.
How do you trade that? Do you put trades before the market open or just at the open?
Well, the way I would look at that is I'm going to frame that with a swing trade lens. And here's what I mean by that. This will help Jonathan too. If I set the 10-day high and 10-day low, and then I might have a pattern that looks like this. So I have 1, 2, 3, 4, 5 DD. Now what I have is a 5 DD pattern. So that comes from the mechanical swing trade course. That's one of the 6 technical patterns that we love. So when I see that, on my spreadsheets and in TC 2000, whatever, that symbol lights up green that, hey, 5DD just triggered. So my standard framing looks like this. I could draw a blue line here. So now I'm stalking it. And my standard method of computing reward to risk considers a mechanical entry to be 5 cents above yesterday's high and 5 cents below yesterday's low. Now, if you're interested in the like a daily NDX, you could also set that equal to 100 and 0. And then just set that equal to 100 standard units. And in general, anything north of that mechanical entry is the green zone, and I want to be long. And anything below that low of yesterday is the red zone, and I certainly want to be short. One of the things that took me way too long to figure out was that a 5DD failure was the best short target ever, especially in a bear market. If you're in a bear market and you get a 5DD and that thing opens inside the yellow zone, which is all of this space inside here. So if that thing closed, like right here, that looks like it closed at the 30, right? On that NDX, because it was like in the bottom 30%. Let's just pretend that's a 30. So what if it doesn't gap at all? What if it just opens up inside the yellow zone? Well, I can trade inside the yellow zone if and only if I can see a 2-to-1 reward to risk inside the yellow zone. And inside the yellow zone means that I set yesterday's high as my price target to the upside, and yesterday's low is my price target to the downside. And then my mechanical entry of 5 cents above and below still is in play. So in this case, imagine that it opened right where it sold off or right where it closed, and then it sells off a fail stat, and then it holds and reverses intraday right where it made a low yesterday. That actually confirms that yesterday's low is support. So now I probably have, if I'm looking at a 30-minute chart, because of this strong sell-off in here, I probably have, if there's my open, I probably had an open and a harsh sell-off, the RL30 split, and I probably get a crossing of the dragon. I probably got a crossing of the dragon. So I get my, sorry. So I get my little entry right here. It crossed the dragon, I get my entry. And now I've got a tactical trade intraday. This is Jonathan's trade. And he sees he's got 1 unit of risk to the low of the day and 2 units of potential reward inside of today's or inside of yesterday's price action. Check or hold. And he knows that if this thing fails, and if it fails through yesterday's low of the day, he's going to automatically be short because it's probably a collapsing dragon. But it's also on a swing trade, the first price evidence that the 5DD pattern is not going back up to the 10-day high, but in fact, it's going to go be a 6DD, a 7DD, an 8DD, whatever. So I could be tapping into 3 or 5 days of continuing panic selling, which is going to be the easiest day trading that you ever did in your life. Check or hold.
Yeah.
Right. So, but if it holds at yesterday's low, that is absolutely significant. That's the most important support level because that's where yesterday the bears ran out of power and the bulls came in and established a bottom. The next most important one is probably the 10-day low or some previous RL10 belly. But just take it as if it was the 10-day low. If the 10-day low also fails, then I could be putting a second position on because now this thing has broken out of the 10-day NDX and is creating new lows. That's exceptional information. That's the best one of all. So on the intraday trade on 3 minutes and or 30-minute bars, I'm tracking this thing as it goes up towards yesterday's, the daily high -1. You know, yesterday's daily high is up here. And if that thing breaks through, then I know that I have a mechanical entry on the 5DD pattern, which says if it can break above yesterday's high, then this has now made the first move back towards the 10-day high. And as long as that thing keeps moving up and making new daily highs, then I love that as a swing trade. And what I'm going to try to do is use my exit rules. I'm going to try to lock in pieces as I'm going up or trailing a risk box or whatever my exit strategy or my exit management is. I'm trying to lock in pieces and parts of that. It's hard to do that on a daily bar. On the 30-minute bars intraday, it's very, very easy because that is a continuous price signal and you're just using the trailing PSAR intraday to trail that. And then when it gets within 30 minutes of the close, you make a decision. Am I still going to hold this one overnight? And your answer is yes, as long as the swing trade signal is still good and it's making new highs, hasn't made a new low. Of course, I'm going to hold the swing trade overnight, but it may be that I can put a turbo trade on my intraday, so I can use this as my swing trade entry, add some day trade position size, get out of that, make some money, and then decide whether or not to hold that overnight. And then I'm going to look at the swing trade pattern in the last 30 minutes and just make a decision. Hey, did it make a new high today and didn't make a new low? Then I'll just keep my small swing trade position on using a much wider stop. And then tomorrow, if that thing opens up in the yellow zone and keeps going, I'm going to add the turbo back onto it. And then intraday, I'm going to be riding that train. And if it never hits my intraday stop, I can keep the swing trade on. But maybe this pulls back and I get out of my day trade, and maybe it keeps falling back and I decide, you know what, I'm just going to exit the swing trade according to my swing trade rules, and I'm done. So this is the way that I can use the swing trade pattern in the 10-day time frame. Plus, maybe I can use mechanical patterns if they fire, and I can use the intraday snipers and hybrid swing 3 and 30 minutes with the SSCs and all that to get some day trading on the day after the swing trade pattern fired. As long as I don't carry day trading position size overnight. Because if you take a look at symbols like EEM, the overnight gap can be 3 times larger than the daily range. That's a bad day at flat rock. You don't want that. So my general rule is if I'm doing day trading on those targets with turbo, and I'm also going to hold a swing trade, I'm going to be like 1/5 or 1/10 of my turbo trading size. So if I'm going to hold 100 shares overnight, I might be trading 1,000 shares with the turbo on the 3 or the 30-minute bars. But when I get to the close, I have to offload 80 or 90% of those shares so that I don't get murdered by the gap. Because this market is only open, for 6.5 hours or 7 hours. And it's closed for 17 hours. And all of the news when the market is closed is what contributes to the size of the gap. And I can't do anything about the gap until the market opens, and then I got to eat it. That's why your overnight risk has to be different than your intraday risk. At least 5-to-1 difference. I would be happier if you were 10-to-1, just for my own peace of mind. But it's also why I find the intraday easier, because I'm getting new information every 3 minutes like clockwork, or 30 minutes like clockwork. And it's a continuous signal. And then there's a 17-hour gap when I wonder what the heck is going on. That's one of the reasons to add a Forex pair to your trading patterns, because you can trade that round the clock except for 30 minutes. And that gives you a chance to experience some trading at different times of the day that may be well suited to you. Now, Satya, did I kind of answer your question?
Yeah, well defined.
What I really
Thank you.
wanted to say was that when you look at yesterday's bar, this was a case where it happened to be part of a 5DD pattern, so that was a special case to me. Hey, it may have just been, it had a favorable auto framer where I take the mechanical entry and just say, hey, the move back to the 10-day high is the reward. And then the size of the daily bar is the risk. So that's the auto framer reward to risk ratio. It doesn't even need a pattern. All it needs is trade location compared to the 10-day high and takes into account volatility based on the size of the daily bar from yesterday. That's about as simple and as elegant as I can make. What I want to see is max pain range compression. I want to see, in general, from the 10-day high, I want to see the largest sell-off, maximum pain, and then on the daily bar from today, I want to see the smallest little doji possible. The smaller the doji, that's range compression. The biggest possible sell-off from the 10-day high, that's maximum pain. I want the biggest sell-off from the 10-day high combined with the smallest daily doji in order to give me my preferred default sort order, which is max pain range compression. That's what the auto framer does, is it calculates this ratio every day. That is the default order that I sort in, because that gives me the greatest opportunity to combine intraday trading in the yellow zone with a breakout on the swing trade if it breaks above yesterday's high. That gives me automatically a combination trade of intraday plus swing trading in a very simple and elegant fashion. So, simple and elegant, Jonathan, there's something in there. I'd like you to reflect on that this week. And I'd like you guys to think about the different indicators and strategies that I've talked about to be able to turn these things into numbers and turn those numbers into filters and searches and sorts and priorities and stuff like that. Well, it covered a ton of things today. That's about a 20-hour advanced swing and advanced day trading in about a 90-minute session for you right there. So you asked for it. All right, what else you guys got?
Quick question.
Yeah.
I created some files and documented all this, but I did not get them to you. Or is there something there?
Just email it to me.
The files themselves, like attach and send?
Yeah, if you want me to review the documents you put together, just email them to me.
Okay.
And I'll take a look at them. Like I looked at some of the ones the guys emailed me. I took a look at that ahead of time and happy to do that.
Perfect. Thank you.
I'm putting together a collaboration area for you guys. You may have seen an invite already, but I haven't built the site out yet in Basecamp 4 that gives us a lot of storage and the ability to, collaborate and share files between us in a Basecamp 4. I'm still monkeying around with that. How to get you invited and get your account established. I think I screwed up the invitation, but I will do that this week so that we have a place where we can store each of our weekly check-ins and any work in progress that you're doing. And then if you're going to end up doing some collaboration with each other and with Jeff and Bill and Luke, they all have accounts in Basecamp 4 as well. So that should give us a chance to do some work, a collaboration workspace among all of us that should make it easier than emailing files. So let me work on that one tomorrow and confirm that I can get you. I may have to delete your last account and set you up as a client or a coworker or something. It was giving me problems setting up the site, and I forgot to fix it this weekend. But I will work on that one tomorrow. But other than that, that's everything I wanted to cover today. I'll get this posted into the course, and then I'll make sure that Jeff Southern and it was Ken Hum. I'll get their two presentations. Ken Hum's I know is on tortoisecapital.net.
Okay.
So I just gotta go and pull that file down and upload it in the OWL course as well. All right, that's everything I got for you guys today. We'll get
Appreciate
after
it. Thank you.
tomorrow. I'm just glad today was Martin Luther King Day and the market was closed. I actually got some other work done because I had to basically go back and fiddle around with Zoom and get it working right. And then Camtasia, where I'm doing the audio book files. That was so stupid today. I read my brother's 50-page section and recorded the audio with the wrong microphone, and it sounded like crap. So I had to reread all his crap again. Another 50 pages, which is about 90 minutes of reading out loud and then fixing the thing. And now, for some reason, it's not playing back right. It's producing a good MP3 file, but the editing software is not letting me listen carefully. So I gotta fiddle fuck around with that now. Anyway, good work today. Good first week. And keep up the fire. We got a lot of interesting things. The swing trade feels like it's pretty important. And having a common frame of reference with that auto framer and MPRC and the BMR, I think there's real value in that. The simplified sniper rules for trading it is going to really simplify our life for trading that in the real world. It's going to be very practical. All right. Take good care, guys, and we'll see you probably tomorrow.
Thank you.
Thank you, Dr. Long.
Thank
Stay
you.
warm, guys.
Night.